So let me take this opportunity to welcome you to our today's session. As we continue discussing about the advanced financial decisions, I just want to introduce to you, and first I just want to discuss about it. I just want to introduce to you the capital structure theories, and when we discuss about the capital structure, it means that are just those theories that talk about the capital structure. Some capital structure theories provide that a capital structure decision is relevant, and other theories argue that the capital structure might be relevant. And there are some of the reasons which are basically provided to answer the question whether the capital structure is relevant. And there is another question which normally arises where we can talk about what is the optimal capital structure of the firm. And when we discuss about the availability or where the capital structure decision is relevant, then the capital structure change will have an impact on the current market value of the firm in its capital structure or in its cost of capital. But basically, we have to be understanding that an optimal capital structure is also known as the target capital structure, which is basically an optimal mix, which is basically the combination of various elements of the firm's capital structures. When we are discussing about the capital structure, we understand that we are just looking on how the organization is going to be financing its projects. And where the capital structure decisions are irrelevant, we say a capital structure change will have no effect on the current market value of the firm. Remember, when it is relevant, it is going to be having an effect on the capital structure and the current market value of the firm, sorry. Now, the capital structure theory is normally classified into three groups, and I just wanted to share my board so that I can be able to write for you the groups which are basically categorized for the capital structures. I think is very important. I think it's very crucial. So when we discuss about it, it means that it is normally categorized into three. And that classification, I just want to put it in writing regarding the same. Let me just migrate my things. In that case, we are just saying that because already I have given you the definition of the capital structure, can you allow me just to know or to talk about the category? How is it normally classified? Sorry. And I say the capital structure theories, the capital structure theory is classified into three. It's normally classified into three. One, we normally talk about traditional theories. We normally discuss about the traditional theories. And when we talk about the traditional theory, we say that the traditional theories is normally includes, or is normally classified into two. We normally check on the net income. We normally check on the net income approach, right? We normally check on the net income approach. Then the second one is always the net operating income approach. The net operating income approach is normally categorized into two. Then let me just look on the other classification, number two. The capital structure is also classified into, we normally talk about Modigliani. Modigliani and Miller propositions. Right? And we know that Modigliani is normally classified into four. We normally discuss about MM1, right? Where we normally talk about an organization where it does not, the MM1 does not recognize taxation. So they allow me to say the MM1 does not recognize taxes. So it is normally done without taxes. Number two, we normally talk about MM2, which recognizes the corporation taxes with corporation taxes. Then we have C. C, we discuss about MM3. Right, MM3, we discuss about the MM3 normally recognize personal, corporation and personal taxes. Corporation and personal taxes, that is the MM3. We also have MM4, that is D. We talk about MM4 with taxes. This one, as we talk about with taxes, there's taxes and financial distress costs. Those are the things which you need to know. Then the last one, the other theories of capital structure, number 3. Other theories of capital structure. Right, here we normally discuss about the pecking order. Pecking order theory. Then number 2, we normally discuss about trading off theories. So I think there are some of the things you need to understand as per your syllabus. It allows you to understand those concepts. So allow me just to explain about the traditional theories as I look on the how do we normally calculate, because basically what we are looking is that the firms have an optimal capital structure tends to maximize their value and minimize the overall cost of the cost of capital. Basically, I will be able to elaborate more for a better understanding regarding to rates. Now, let me start by analyzing the net income approach. Let me call it number 8 here. Net income approach. Net income approach. Let me just give a definition, and I say that this is a capital structure relevance. It is a capital structure. It is a capital structure relevant theory. Relevant theory. Right, relevant theory that provides that normally provides that a capital structure decision is relevant and therefore a capital structure change will have an effect. A capital structure change will have an effect. Will have an effect on both the value of the firm. Will have an effect on the value of the firm and its WACC. That is what we are discussing about. So it means that when I'm going to be changing anything, when I'm going to just be changing the capital structure, it will just have an effect on the value of the firm and also the WACC. That is what we are discussing about the net income approach. And that is why here I say the theory normally argues that the firm increase the amount of debt in its capital structure. the current market value of the firm will also be increasing, and its WACC will be able to reduce. We are just going to be checking on how is that applicable when we are doing our illustrations. However, we are saying the increase the amount of debt in the capital structure should occur up to optimal gearing point. This implies that if the debt is increased beyond this point, the firm's value begins to fall and its WACC increases. The theory is based on the two assumptions. One, the cost of equity of a firm will remain constant as the firm increases the amount of debt in its capital structure. Two, we talk about the cost of debt shall always be lower than the cost of equity. But basically, when we are going to be analyzing these concepts, one, you just need to be understanding that the firms are normally categorized into two. One, we normally discuss about unlevered firms, right? And we also discuss about the levered firm. And we know very well that the net income will not be able to, it normally assumes that the taxes will not be able to exist. That is the assumption which it comes with the net income approach. But I have already introduced new things here, or the new terms, where I'm discussing about the unlevered firm. And when we talk about unlevered firms, we say that it's just a company with no debt. It does not have any, it does not finance using a debt. And it is normally called unlevered because it does not have any financial leverage. And we say that the financial leverage are basically created, is normally created when a company utilizes borrowing, usually from lenders by issuing it through bonds. So it means when you're dealing with the question of the net income approach, it means that, right, it means it assumes that the taxes do not exist. It assumes that the taxes do not exist. A lot of theories will not be able to help you. What you need just to understand is, when I'm given a question regarding to net income approach, and then the examiner is going to be asking me to calculate, for example, the WACC of unlevered firm, what am I going to be talking about? And I said that the firms are normally categorized into two based on how they are being financed under the capital structure theories. Here we are discussing about unlevered and levered firms. The levered firms are financed by both equity and debt, but under the net income approach, they don't recognize the availability of debt under the unlevered firms. So let us look on the computations of the WACC when we are dealing with the unlevered firms. And I've said these are the firms which are operating without debt. Right? They are operating and existing without debt. So in this case, it means when the examiner is going to be asking you to do the computation of the WACC of unlevered, this is, I'm just stating as unlevered firm, right? It means that in this scenario, when you are dealing with unlevered firms, the WACC of unlevered firm will be the same as the cost of equity of unlevered firm, which we normally get it by taking the expected dividends we divide by the market value plus G, right? I think that one is already determined. And in this case, it means that we are not going to be having any growth rate. It means our growth rate will always be zero, correct? Then it means that our expected dividends might be the same as the profit after taxes as provided by the examiner. Then when you look on the market values, right, we are just going to be looking on the value of equity. This is the value of equity. Then also we have to be analyzing using the value of debt. This is the value of debt. The value of debt. Do you remember we have said unlevered firms, they don't recognize the availability of debt because those firms are basically 100% financed using equity. And in that regard, I just want us to be able to look on, if, for example, these conditions applies, if this is what is happening to you, let me just give you a concept here. And we are saying that because we have said the WACC of unlevered farm is the same as the cost of equity of unlevered farm, which we can get it by taking the expected dividends divided by the market value plus the growth rate. And I have said that our growth rate might be at 0, right? The D1 is the same as the profit after tax in this scenario. The market values, we are just going to be analyzing for equity and debt. And in this case, if those things are not available, this one might not be provided in the question. Then the biggest question will be, how am I going to be getting the WACC of unlevered farm? And I say, the WACC of unlevered farm, which is the same as the cost of equity of unlevered farm, you can take EBIT, you divide by the value of equity. Correct. It means that you can be able to take the EBIT, you divide by the value of equity. Now, when you look at it, because the examiner will be asking you, what is the value of the farm? So to get the value of unlevered farm, right? In this case, I'm discussing about the VU. How am I going to be getting it? I say the value of unlevered farm should be the same as the value of equity of unlevered farm, right? And we know very well, these are all finance or equity. We don't have debt here. Or equity financed. Or equity financed. So it means to get the value of equity of unlevered farm, which is the same as the value of equity, the value of unlevered farm, which is the same as the value of equity of unlevered farm, we normally get it by taking the earning before interest and taxes. We divide by the cost of equity of unlevered farm, the cost of equity of unlevered farm, or remember, the examiner might not be able to give you the earning before interest and taxes. What if you take the market price per share, you multiply by the number of ordinary shares? We shall be able to check on different circumstances provided by the examiner. Let us look on the second farm. I have talked about, we normally have unlevered farms, and also we normally have levered farms. So our B here, I'm going just to be analyzing my levered farms. And these are the farms which are financed both by, debt and equity. They are financed by both debt and equity. So to get the value of the levered farm, it means I'm just going to be taking the combination of the value of equity plus the value of debt. The value of equity plus the value of debt. So in that scenario, it means to get the WACC of the levered farm, it means L means the levered farms. Then it means that you have to be taking the weight of equity, cost of equity, plus weight of debt, cost of debt. Do not be changing the one that you have been using. That is how we are going just to be getting the value. That is how we are going to be getting the value. So to get the value, to get the WACC of the levered farm, we just take the normal weighted of equity, the weight of equity, cost of equity, plus the weight of debt multiplied by the weight of debt multiplied by the cost of debt. But in most cases, examiner may not be able to provide these ones. Examiner might deny you, right? Might not be able to provide the cost of equity of the levered farms together with the cost of debt of those levered farms. How am I going to be getting them? To assist me computing my WACC. And I say, to get the cost of equity of the levered farm, I'm going just to be taking the profit after tax, we divide by the value of equity, which is the same as, sometimes the examiner may be giving you the EBIT rather than giving you the profit after tax. Then he might be giving you the EBIT. You just need to subtract what? We subtract our interest, right? We subtract our interest, we divide it by the value of equity of the levered farms. What about the cost of debt of the levered farm? Now you say, if the cost of debt is not provided, if the cost of debt is not given, then it means I'm going to be taking the EBIT minus interest. Sorry, I'm just going to be taking my interest. Sorry for this. You divide by the value of debt. You divide by the value of debt. And remember, I have said that the examiner may be able to deny you some few things here. you see, we talked about having the value of equity here. And also we are applying the value of equity of the levered farm. And the biggest question is, when the value of equity of the levered farm is not provided, it means already you should be having the cost of equity of the levered farm. So when you cross multiply, you are just going to be getting the value of the equity of the levered farm. What do I mean? It means to get the value of equity of the levered farm, I'm just going to be taking my EBIT minus interest. You divide it by the cost of equity of the levered farm. The cost of equity of the levered farm. I just want to look on a small illustration here. There is a question tested on November 2019. November 2019, there is a question there which talks about these cases. So let us just go there. Let's go there, right? November 2019, question 4B. November 2019, question 4B. November 2019, question 4B. November 2019, question number 4B. Let me just share my board or share my questions to have someone reading for us. So who is reading for us? November 2019, we have question number 4B. 4B. Someone to read for us, please. Kindly, please, someone to read. No one who can read for us?
Read.
Go on.
Property A and property B are categorized under the real estate category. Property A is all equity financed, while property B is financed partially using debt and partially by equity finance. Both properties generated operating profit (EBT) of 41,245,900 annually. This is expected to remain constant each year in perpetuity. And unlike property A, which is wholly equity financed, both property Unlike property A, which is wholly equity financed, property A is financed partially by equity and partially by 10% debt of 215 million. The cost of equity is 12% of both properties and there are no corporation taxes. Each unit of debt is trading as per required the current value of each property using the net income approach.
Good question provided there. We have already been told that we have only two properties. We have property A and B. We have been told that property A is fully equity financed, while property B is partially by debt and equity. It is a very good to understand the net income approach, and we are saying both properties generate operating profits of 41,245,900 annually. This is expected to remain constant each year in perpetuity, unlike property A, which is wholly equity financed. Property B is financed partly by equity and partly by debt of 10% of 215 million. The cost of equity is 12% for both properties, and there are no corporation taxes. Each unit of debt is trading at par. Required, we are being asked about the current value of each property using the net income approach, right? Using the net income approach. There is someone who might be calling me Beatrice or Rose. Okay, she's not here. So let me just continue. So in that case, in that scenario now, in that scenario, I just want to give you a solution for this current problem so that you can be able to understand better. So in that regard, let me start by computing for property A. I just want to start with the property A here. Property A, which is equity financed only. Now, in this case, remember, I just want to get the value of equity. This is unlevered because it is equity financed. This is unlevered. So to get the value of equity of unlevered, right? Which we said we can get it by taking the earning before interest and taxes. We divide it by, we say the cost of equity of unlevered, but we are discussing about property A. So don't forget that. We are discussing about property A. So how am I going to be getting my solution here? Right, I say that the examiner has already provided you with the earning before interest and taxes amounting to 41. I'm going to pair 41 to 45. 900. We divide by the cost of equity. We have already told that the cost of equity as per the question is 0.12. What is the value of this organization? What is the value of this property A? They'll say, I take 41 million, 245, 900, divided by 0.12, getting something closer to 343. 343 million, 715, 833. That is the value of property A. And that is the requirement by the examiner. That is the requirement by the examiner to determine the value of property A. Now, let us do property B now, which is partially 1 minute. I have already calculated for you the value of the farm or property A. I just want to calculate for property B, which is partially, this is the levered farm. So how is the levered farm of, how do you normally get the value of the levered farm? We have said, you normally take the value of equity plus the value of debt. And in this case, remember that to get the value of equity of this property, B, the value of equity of B shall be, we have said take your EBIT minus interest. We divide it by, right? EBIT minus interest divided by the cost of equity. And in this case, we know very well, our EBIT is 41,245,900 minus our interest. We have been told this organization is normally financed by 10% debenture. So in this case, it will be 10%, you multiply by 215 million, right? Then we divide it by 0.12. We divide it by 0.212. How much are we getting here? So it means 0.1 times 215, which is 21, which will be having 41,245,900 minus 21,500,000. You divide it by 0.12. How much are we getting here? We say that, let me just take 41,245,900 minus 21,500,000, getting 19,745,900 divided by 0.12. We are getting the value of this firm as 164,549,000, right? 167. Those are the values of the firm. Those are the values of the firm. You can be able to see them there. Now, what about if the examiner was asking us to compute the WCC? Because I don't think if it is a requirement in the question, let me just check. We were being the current value of each property using the net income approach. But let me talk about what if we were being told to calculate the WCC of both, for both properties. How much are we going to be getting here? Let me start with property A. And I will say, under the property A, we have said, the WCC of an unlevered farm is the same as the cost of equity. In this scenario, we just say the WCC of ours now translate to be 12%. But what about for property B? And for property B, I will say, if, for example, they are asking you to calculate the WCC of the levered farm, we say, take the weight of equity, cost of equity, plus weight of debt, cost of debt. And I said, very well, you have to be determining the cost of equity. You have to be determining the cost of equity. And in this scenario, the cost of equity is already provided, which is 12%. If it is not provided, I have given a certain formula somewhere. And in another scenario, we talk about the cost of debt. We are going to be using the interest rate of the debenture, which is 10%, And in this case, it means we have to now to be calculating the WCC of this levered farm. And how are we going to be getting it? One, we have to be determining the value of the levereds. And we say we have to be taking the value of debt plus the value of what? The value of debt plus the value of, we have the value of debt. So I think there is something which I did not continue here. Because what I was able to get here was the value of equity, correct? The value of equity. So in this case, to determine the value of the levered farm, you just take the value of equity, 164,549,167, plus the value of debt, which is around 215 million. 200 million. So what is the value of the levered farm? What is the value of the levered farm? Let me just get back there. So I just take plus 215 million, which I'm getting Kenya shillings, 379,549,000, right? 167. So if I want to calculate the weight, what am I going to be doing? Very simple here. I'm just going to be taking 164 divided by the total to get the weight of equity. And in this case, it is very simple. Just say 164,549,167. You divide it by 379, right? 549, we have 167. We multiply by the cost of equity, which we have said is 12%. So I just put 12 there. Then we divide it by, right? We add the weight of debt. They just take 215 million we divide it by 379,549,167. Then I multiply this by 10. So what will be the weighted average cost of capital for the levered farm? I just say 164,549,167. I divide by my answer. I will be able to get something closer to 0.43 times 12. Ukitaka to calculate the other one, you can, but you are going to be getting, because you know the weights are supposed to be equal to 1. This one will be 0.57 times 10. So what is the WCC of the levered farm? I just say 0.43 times 12 plus 0.57 times 10. We are getting 10.86%. 10.86%. That is how you normally compute the WCC of a levered farm. The WCC of a levered farm, that is how it's normally computed. Unless there is a question, there. I think it is it's very clear. Unless there is a question, it should be clear. It should be clear. So let me proceed. Let me proceed to the conclusion. When, for instance, when you compare our weighted average cost of capital of this levered farm, when you compare it to the cost of capital, you remember what we said, the debt will be able to increase the value of the farm, and that is what you can be able to see here. When you compare 379 and 343, it means that the debt is going to be increasing the value of the farm and reducing the WCC. You can see our WCC has already reduced here under the net income approach because it has reduced our WCC. When you look under the unlevered farm, it was our WCC is 12%. But when we incorporate our debt, the debt has already reduced. The WCC has reduced. So it means that the capital, in the notes that we passed through earlier, we said now that this information we are discussing here is that the capital structure financing decisions are relevant. But if it goes the other way, then it means it should be irrelevant. And that is what we discussed at the initial stages. Now, I will be able to request to combine two things here, right? Allow me to combine two things as we continue with our syllabus. I just want us to combine the net operating income, right? The net operating income. Let me continue here. I just want to combine two things here. Number two, the net operating income. The net operating income and MM1. The net operating income and MM1. That is the thing that I just want to combine, and I say that they state that, right? Because they analyze similar things. I say they state that in absence of taxes, and debts, debt has no effect. Debt has no effect on the value, or WCC. The WCC of the farm. In this case, it means when you are dealing with the MM1 or the net operating income, the value of the levered farm should be the same the value of unlevered farm, which you normally get it by taking earning before interest and taxes, you divide by the WCC. You divide it by WCC. And in the same scenario, we say to calculate the WCC of the levered farm, we should be also getting the same for the unlevered farm, which you are going to be taking earning before interest and taxes. You divide by the value of unlevered or levered, right? Because it means the WCC of the levered farm will be the same as the WCC of unlevered farm, which you normally take the earning before interest and taxes, divide by the value of unlevered or levered farms. Allow me now to shift my gears because I just want to combine all this information for further or to boost our completion of certain Modigliani and Miller propositions. So allow me just to go to number 3. I talk about MM2. We say this normally it recognizes the availability of corporation taxes with corporation taxes, right? We discuss about with corporation taxes, and I say here, MM, right? Modigliani and Miller argued that, was able to argue that in the environment of taxes, the use of debt would increase. The use of debt would increase the value of the farm and reduce the WCC of the farm. Will be able to reduce the WCC of the farm because of the interest tax shields, and it lowers the risk and it lowers the risk to the investor. I have said under the MM2, right? I have said under the MM2 that the Modigliani and Miller was able to argue about that when we have our taxes, is going to be reducing, or is going to be in the environment of taxes, the use of debt would increase. The use of debt would increase. I have forgotten that. Would increase here. Would increase the value and reduce the WCC of the farm because of the interest tax shields, which lower the risk of the investor. And remember, because we are analyzing two concepts here, where we are dealing with unlevered farms, which are equity financed. It means here now we recognize the availability of the corporation taxes. So when you're calculating the questions for unlevered farm under MM2, unlevered farms under question 2 here, MM2, sorry, it means to get the value of unlevered farm, which is the same as the value of equity of unlevered farm, we normally take the earning before interest and taxes. We adjust for taxes, then you divide by the cost of equity of unlevered farm. The cost of equity of unlevered farm. That is one concept. And also we are saying that to calculate the WCC in this scenario of unlevered farm, we normally take the cost of equity of unlevered farm, which is the same as EBIT. You adjust for your taxes, then you divide by the value of equity of unlevered farm there. Secondly, analyze when you are dealing with the levered farms. When you are dealing with the levered farms, we say to calculate the value of the levered farm, which you normally get it by taking the value of unlevered farm plus the tax shields on total debts. Right? When you're calculating the value of the levered farms under MM2, it means we are going to be taking the value of unlevered plus the tax shield on the total debts. The question will be, how do we normally get the tax shield? on total debt. How do we normally get it? I say to get it, we normally take the value of debt, we multiply it by the sorry for that. I have said very well. When you are dealing with the levered farms, to get the value of the levered farm, right? To get the value of the levered farm, we normally take the value of a levered farm plus the tax shield on the total debt. How do you normally get the tax shield of the total debt? I say you normally take the value of debt, you multiply it by the tax rate. You multiply it by the tax rate. And in that case, I have said, then it means in simple terms, if I say this, to get my value of the levered farm, I can take the value of a levered farm plus the value of debt times the tax rate. Nikisema hivyo, I will not be making any mistake. Then from there we say, if we want to calculate the WCC of the levered farm, then it is very simple. I just need to take the weight of equity, cost of equity, plus the weight of debt, cost of debt, and then you incorporate your taxes. Incorporate your taxes there. Incorporate your taxes. And in this case, it means to get the cost of equity, because I say sometimes they might not be provided in a question, right? If they are not provided, to get the cost of equity of the levered, it means I have to be taking the cost of equity of unlevered plus the risk premium. Right? I've said if we are calculating the cost of equity of the levered farm, it means I'm going to be taking the cost of equity of unlevered. We add the risk premium. But sometimes students normally ask, how are we getting this the risk premium? I say to get my risk premium, you have to master the formulas. So to get the risk premium, it means you're going to be taking the cost of equity of unlevered minus the cost of debt. You take the ratio between the debt and equity, then you adjust for taxes. You adjust for taxes. You adjust for taxes. You adjust for taxes. Then from there, you can decide to use this formula to equate here, right? If you want, you can be able to use it here to equate on this side. No problem with that. Now, allow me to do an illustration for better understanding. I will start with a question tested on November 2016. Then I do another one for May. Just choose one between May 2019 and 2018. As I look on completing these Modiglianis. Right. Let us go there. So let us do November 2016. Just do 2 questions there. So November 2016, question 3. November 2016, question 3. Might be having a challenge for my network. It might be slow. Someone to read for us. Someone should be reading for us the question.
Maju Limited is just about to commence operations as an international trading company. The firm will have a book value of assets of 320 million shillings, and it expects to earn 16% return on these assets before interest and the taxes. However, because of certain tax arrangements with foreign governments, the company will not pay any taxes. It is known that the capitalization rate for an all-equity firm in this business is 12%. The company can borrow debt finance at the rate of 7% per annum. The management is in the process of deciding how to raise the required 10 million shillings debt finance. Assume that the M&M assumptions apply. Required. Using the model without taxes, determine 1. The current value of the unlevered farm. 2. The current value of a levered farm if it uses 10 million shillings of 7% debt. 3. The WACC of a levered farm at a debt level of 7%, 10 million shillings.
Thank you so much.
C.
Okay, before C. Let me just first do the first requirements for B, whereby we are just being told that the firm will have a book value of assets of 320 million and it expects to earn 16% return on these assets before interest and taxes, or because of certain tax arrangements with foreign governments, we are being told that the company will not pay any taxes. The company will not be able to pay any taxes. Now, in that regard, we are being told that, however, it is not that the for capitalization rate for all equity firm in the business is 12%. Capitalization is going to be used at the cost of equity. Now, the company can borrow debt finance at the rate of 7% per annum. The management is in the process of deciding how to raise the required 10 million debt finance. Assuming the Modigliani assumptions apply, we are being told, number 1, to calculate the current value of unlevered farm. The current market value, that is MM1. And in that regard, it means when I'm calculating these requirements, this is what I'm supposed to be doing here. We are doing November 2016 question 3. Right, November 2016 question 3. So I will start with B. Let me start with B here. Requirement number 1. I'm told to calculate for the unlevered farm. And in this case, I will be able to say, to calculate the value of unlevered farm, I'm just going to be taking my EBIT, I divide by WACC of unlevered farm. And in this case, we have said the WACC might be the same as the cost of equity of unlevered farm. But there is only one thing that we don't have, the earning before interest and taxes, right? What is our earning before taxes? And we have already been told there, in the question that the earning before interest and taxes should be, there is a proportions which are already been given there. Okay,